QQQ's 100% return edges out IVW, but it crashed harder and recovered 99 days faster when markets rebounded. QQQ recovered fast at 405 days, but IVW lagged 99 days longer despite a smaller crash. Recovery speed matters. Over the past year, QQQ edged out IVW by just 1 percentage point, 16 versus 15%. QQQ is leading the pack with 100% returns over 3 years, while IVW trails just 5 points behind at 95%. 5 years, 2 different strategies, yet both landed at exactly 88%, completely identical, despite taking different roads there. QQQ wins the short sprints, but here's the twist. Over the marathon distance, both race cars cross the finish line at identical times. Both QQQ and IVW deliver identical 1.1 Sharpe ratios, meaning they're equally efficient at converting risk into returns. Both funds protect you equally during market drops. That 1.5 Sortino ratio shows identical downside risk management here. Think mechanical leverage. Both ETFs give you identical reward for each unit of risk. Same efficiency, no clear winner on risk-adjusted returns here. QQQ's 23% volatility runs 2 points higher than IVW's 21%. Expect wilder swings with your tech-heavy bet. QQQ's your wild roller coaster, bigger thrills, steeper drops. IVW smooths things out just enough that you'll actually notice the difference in your stomach. QQQ crashed harder, dropping 35% at its worst, while IVW held slightly better at 33% down. IVW lagged behind, taking over 3 more months to bounce back from its worst losses than QQQ did. QQQ's swimming pool went deeper at 35%. But here's the kicker. It also gave you the fastest ladder back to the surface compared to IVW's 33% dunk. QQQ's focused with just 102 stocks, while IVW spreads its bets across 217, over double the diversification. IVW's price-year valuation shows investors are paying nearly 2 extra points per sales dollar versus QQQ. QQQ concentrates your bet on 102 companies, while IVW spreads across 217. But here's the catch. IVW is paying a premium for those eggs. Let's recap what we've discovered. QQQ edges ahead on short-term gains, bounces back faster from crashes, but risk-adjusted, they're dead even. IVW saves you 2 basis points annually with its 0.18% fee versus QQQ's 0.20% expense ratio. That 2-cent difference might feel like couch change now, but over decades it compounds, turning pocket lint into real dollars you'll actually keep. IVW loads up on financial services at 10%, while QQQ barely touches them at just 0.28%. QQQ gives you 25 times more global reach than IVW, holding companies across international markets beyond just America. The IVW loads up on financials while QQQ basically ignores banks entirely. Meanwhile, so QQQ's got more international flavor baked into its holdings, different pizza toppings, different risk profiles. QQQ's $400 billion in assets absolutely dwarfs IVW's $66 billion. It's 6 times bigger in scale. QQQ wins on returns and recovery speed, while IVW offers lower costs, less risk, and better diversification. So here's your report card. QQQ wins on speed and bounce back, while IVW takes cost and stability. Which subjects matter most to you? QQQs for thrill seekers chasing maximum returns, while IVW offers steadier growth with less drama and broader sector balance. QQQ's the marathon runner who sprints ahead with wild swings, while IVW's your steady pacer with banking exposure. Less drama, more consistency throughout the race. You're responsible for your decisions. Consult professionals and do your own research first. If you want more deep dives like this, hit that subscribe button for weekly ETF breakdowns with real data.